There's a little sneaky little rule change that's coming down the pipeline, and it could either be a surprising gift or a painful poke in your financial ribs, depending on your income and how you save. And if you're in the fabulous 50s club, this is especially important to you. And we're talking about a brand new twist to the TSP game brought to you by the Secure Act 2.0 from 2022, which they waited all the way until 2026 to take effect on a new change. So listen carefully and closely because this isn't just about boring legislative text. This is about your money, your taxes, and whether Uncle Sam gives you a little break or not. Now, let's peel back the layers on this beast because understanding the why and how is crucial here. Why did Congress do this back in 2022? Well, this was a very quiet way to raise taxes on people earning more than $145,000 a year if they elected to make catch-up contributions to their 401k, 403b, TSP, or the 457 plan. Do I agree with it? No, I don't. And this is just my opinion. I don't think Congress should take away people's choice to contribute between Roth or traditional, but Congress justified that this provision was needed to balance the other tax credits and deductions in the Secure Act 2.0. But nothing anyone can do about it now because it was already signed into law back in 2022, unless Congress repeals it, which I'm not seeing in any current proposals. But anyway, I'm going to stick to more facts in this video. Here's the how. Starting on January 1st, 2026, the IRS is going to require you to make Roth contributions. And we're talking specifically about catch up contributions if you make more than $145,000 a year in 2025. And I'm going to explain the income threshold later on in this video. If you're under 50, hang tight because this is good info for future you. But if you're already 50 and above or are getting close, Uncle Sam gives you a little extra allowance each year. You can contribute to your retirement accounts on top of the standard limit, but it's going to come with an extra rule. To break down the numbers for 2025, the catch-up contribution is an extra $7,500 on top of the $23,500 limit for everyone. So that's a total limit of $31,000. And for those age 60 to 63, that catch-up contribution jumps from $7,500 to $11,250, which brings a total limit to $34,750. And when you turn 64, that catch-up contribution limit goes back down to $7,500. And keep in mind that if you're 49 years old right now, but you're turning 50 by the end of this year, then you can actually start making those catch-up contributions because you're technically going to be 50 for the calendar year anyway. And same thing for those of you who are 59 years old, but if you're turning 60 at any time this year, you can start making that $11,250 in catch-up contributions instead of $7,500 because you're going to be 60 by the end of the calendar year anyway. That makes sense so far, right? Now, here's the thing. Starting in 2026, if you make more than $145,000 in total wages with your current employer in the calendar year 2025, then you have to put your catch-up contributions in the Roth TSP. And keep in mind that contribution limits for 2026 will not come out until the end of October or the beginning of November in 2025. So as right now, I'm just going to say it's $7,500 and $11,250. So again, starting on January 1st, 2026, if you make more than $145,000 in wages in 2025, your catch-up contributions have to be in the Roth bucket of the TSP. So let me break down the income. If your W-2 wages in 2025 were more than or equal to $145,000, your catch-up contributions can only go into the Roth TSP. That's right, mandatory Roth. But if you make less than or equal to $144,999, then you can put your catch-up contributions in either Roth TSP or traditional TSP. And something else I want to clarify is that this is about your wages with your current employer, which means it's the amount you're being paid for the entire year of 2025 from your current employer. Your spouse's income does not count, and the wages from your other jobs do not count. This is only with your current employer. So let's say you're a federal employee or an active duty military service member making at least $145,000 in total wages in 2025, and you're going to be 50 years old next year, then your employer is going to turn off the traditional TSP option just for your catch-up contribution for $7,500 or $11,250 if you're between 60 and 63 next year. And your wages can include your annual bonus, Sunday premiums, overtime, or night differential pay if you receive any, because that's considered your taxable income. For service members, your BAH and BAS do not count because they're considered non taxable income. And remember, your total wages are after your deductions like your health savings account or HSA, flexible spending account or FSA, dental premiums, healthcare premiums, and traditional TSP. However, keep in mind that some of your deductions, like the union fees, FEGLI, and first pension contributions, are in after tax, so they don't lower your wages. And if you're right at the income threshold and you want to continue making traditional TSP catch up contributions in 2026, then you should find out what you can do to lower your wages in 2025. And this is obviously not in any form of personalized financial advice because your personal finance is very personal. So your situation may be entirely different from someone else's. You can always look at your W-2 from the previous year in 2024 so that you have a better idea about what your wages were in the previous year. However, if you want to look at the most accurate wages now, you need to look at the most recent pay stubs to see what your wages are so far this year in 2025 and what they're projected to be by the end of the year. If you're still not sure what you should look at, you can always schedule a 60-minute consultation with me by visiting firestarshare.com/consultation. So let's do some simple math. And let's say you're single and you're over 50 and you were planning to contribute that 7,500 catch up into traditional TSP. You would typically shave $1,800 off your tax bill for the year, assuming it belongs to the 24% federal marginal tax rate, and that's not accounting for your state income tax. But under this new rule, if you're over the $145,000 wage limit, that 7,500 must go into Roth, and Roth means after tax. So that upfront tax break of $1,800 will be gone for the year, which lowers your take-home income. And I want to be clear that the income threshold will also be adjusted for inflation each year. So the IRS is not locking it at $145,000 forever. It could become $150,000 for the income threshold in 2026 to make traditional TSP catch-up contributions, but you'll need to check it annually, especially if you're hovering near the edge. And I will be sure to keep you updated whenever the IRS releases those numbers, so be sure to subscribe if you haven't done that already. Now, let's talk about the pros and cons of this mandatory Roth catch-up specifically for those who are affected. First up, Roth will give you that tax-free growth and withdrawals in retirement. And this is the big one for Roth. You pay taxes on the money now, yes, but then every single dollar of growth, every penny of earnings, and all of your original contributions come out completely tax-free in retirement at age 59.5, assuming you follow the Roth withdrawal rules. And if you believe you might be in a higher tax bracket in retirement than you are now, getting tax-free withdrawals later is a huge advantage. In other words, forcing more money into Roth means more potential for tax-free income when you stop working. Now, another fantastic feature of Roth is that the original account holder is not forced to take out money in their lifetime, also known as required minimum distributions or RMDs. This means your Roth TSP balance can generally keep growing untouched, free from RMDs for your entire life. And this gives you more flexibility in retirement because you're not forced to withdraw the money at a certain age. You can leave it, invest it, and let it keep growing tax-free for as long as you want, or even use it as part of your estate plan. And by requiring catch-up contributions to go into Roth, it also means that money won't be included in your RMDs later, which gives you more control over your taxable income in retirement. And one more advantage is the tax diversification in retirement. Having both traditional and Roth savings is like having both a hammer and a screwdriver in your retirement toolbox. You've got options. Say you need to take out a chunk of money for a surprise expense, like a new roof or a surprise destination wedding that you didn't vote for. I don't know. But if you pull from your Roth account, that money comes out tax-free, which could help keep your taxable income lower for the year. And that matters because a lower income could mean paying less for Medicare and keeping more of your Social Security benefits. But if all of your money is pre-tax, every withdrawal hits your tax bill like a ton of bricks. Having both types of accounts gives you more control. And you know what they say, control over your taxes in retirement is pure gold. Now, let's flip the coin and look at the cons. And the primary one, which we already touched on earlier, is no more tax deduction now. And this is a big one because for folks in high tax brackets today, losing the ability to deduct 7,500 or more could sting, especially if you were relying on it to reduce your taxable income this year. Now, if you're thinking about accessing those funds in retirement, the rule of 55 lets you access your traditional TSP funds penalty free if you retire or separate from service in or after the year you turn 55, right? But that doesn't apply to Roth TSP in the same way because you're going to get hit with the pro rata rule, which means that a portion of your Roth TSP is going to be taxed and penalized under the rule of 55. To avoid a penalty, traditional TSP is much more beneficial under the rule of 55 because you don't get penalized for the earnings, but you will just owe federal and state income taxes on the distributions. Since this new rule forces your catch up contributions into the Roth bucket, but if you're a higher income earner, that specific catch up money does not benefit from the rule of 55 access. If you plan on potentially using the rule of 55 to access some of your catch up money between ages 55 and 59 and a half, and you're subject to this mandatory Roth rule, that option is gone for that specific money. Now you have to wait until 59 and a half to access the earnings portion of those mandatory Roth catch up contributions without penalty. So you potentially lose a bit of flexibility in accessing those particular funds in that specific age window. And that would be a bummer for folks who were counting on that rule of 55 access for their entire catch-up amount. And this mandatory Roth catch-up provision was actually part of the Secure Act 2.0 legislation passed in late 2022, and it was initially slated to take effect on January 1st, 2024. And yes, last year. So why the delay? Well, here's what happened. Payroll systems across America went into panic mode. Employers were expected to track whether each employee crossed the $145,000 mark mid-year and automatically reroute their catch-up contributions from traditional to Roth accordingly. Well, most payroll systems were not ready for that. And the entire industry actually asked to delay this new rule. And the IRS actually listened by delaying the start date to January 1st, 2026. And this gives every employer and everyone, including payroll providers, a little breathing room to prepare. And here we are in 2025. It is time for everyone to pay attention to this rule that no news network has really talked about. Now, I've been known to get a little bit into the weeds with the data. And if your head's spinning faster than a squirrel on caffeine, well, don't worry. My job here isn't just to dump information, it's to make it make sense for you. So before you go off and wonder, what the heck am I supposed to do next? Here's some actionable strategy talk that I want to share with you. One, evaluate your 2025 income. Take a look at the wages you're paid so far in 2025. How many more paychecks are you going to have for the remainder of the year? And calculate what your estimated income is going to be and see how close you are to the $145,000 income threshold. And two, estimate what your take-home income looks like in 2026 with the Roth catch-up contributions. If you'll be over the wage limit in 2025, prepare to have a lower take-home income on that $7,500 or $11,250 in Roth catch-up contributions. But that's if you elect to contribute. And obviously, it's not mandatory to contribute to the Roth contributions every year. The choice is yours, which leads to number three, and that's to consider your overall Roth strategy. And this rule might actually be a nudge in the right direction for some of you. Maybe you're already thinking about leaning into Roth for long-term tax benefits. It's just less fun when you're forced to do it, right? But if you're close to your retirement age, find out if it's beneficial for you to contribute to the Roth by calculating your future tax rates. And if you have time to let this Roth money grow tax-free for a while, maybe your taxes will be higher with multiple income sources during your retirement, or maybe your taxes will be lower because you won't have many income sources. So what do you think of this new rule starting in 2026? Is it going to benefit you, or is it going to do the complete opposite? And I would love to know your thoughts in the comment section down below. And this has been another beast of a video, and I hope you got a lot out of it.